What do you make of this? You think this is a step forward, these memos?
Look, I think they're all baby steps forward. But at the end of the day, as Bob said, it's very complicated in terms of the various issues that need to be resolved over time. I think we get the optics of a deal before the deadline on March 1st. I do. However, I do think we also get a push. I think it's a balance, and I think the president is well aware that trade does affect markets. That said, I think that positive outcome is largely largely priced into markets right now, and I don't really see a trade resolution in really any form, frankly, providing a positive catalyst to markets here. With the S&P closing in on 2,800, I think we're fairly valued given the other tailwinds, the absence of other tailwinds. Into the end of the year.
Yeah, Jack, that's a pretty popular narrative right now, this notion that China trade talks have been exhausted as a upside catalyst, and really what would be more powerful right now would be some kind of formalization of the Fed's posture in recent weeks.
Yeah, I think that certainly having the Fed kind of more or less say, no hikes and no reduced balance sheet has a calming effect on the market. I do think, however, as Bob pointed out, expectations for trade resolution is running very high, subject to a lot of disappointment, especially since you've got Lighthouser and others who are really looking to create policy. This is multi-year policy. This isn't necessarily just a tactic to try to, get a better deal on, imported Barbie dolls.
So what's going to get us over, Peter? 3,000. We're at 2,800 on the S&P. I think you and I probably agree. The central catalyst on the turnaround has been central bank flexibility. Powell announcing he was flexible. ECB announcing they are fairly flexible. That was the bottom and helped. That moved the markets up, trade optimism, but we've got this concern about an earnings recession out there. A lot of people believe the market was down last year, signaling there would be some kind of earnings recession. And with this, the global growth slowdown is not helping. I keep waiting for better news out of Europe. It's crummy, it's lousy, and China isn't improving much at all. So how do you get this stew together to get us to move the market forward? It's kind of tough right now.
I do. Again, I think the positive catalysts are in the rearview mirror, and we have to keep in mind as well, why did the market sell off the way it did at the end of last year? It was a miscommunication by Chairman Powell at the meeting that actually followed the ECB announcing that it was going to end QE in mid-December. That really led to this feeling, I think, that the Fed put was gone. And it wasn't until early January at the AEA meeting where that flexibility began to creep into the communication, and then a number of Fed governors marched out over time, communicating that said flexibility. At the same time, though, rest of world growth has really rolled over. Europe is showing real signs of strain now. We've got France, Germany now deeper into contraction for the second month in a row. That's been part of our narrative for some time. And by the way, as has the rally in the S&P 500 on this communication shift. I don't see really further catalysts. Earnings are rolling over. Revisions now for Q2 from 7% now to about 2%. It just isn't setting up all that well from a fundamental perspective into the end of the year.
Well, Jack, what do you make of that earnings recession? We've had a huge debate about this. If you're at 0% earnings for this year, the market is darn pricey. We're close to 17 times forward earnings. Even if you have 5%, we're at 16 or so. Can you make an argument to expand the multiple when we're getting global economic flatness like this?
No, I don't. I think, our view is I think we can get low single-digit earnings growth, certainly a far cry from the 20% growth we got last year. I do want to throw a silver lining in Europe. I do think one of the perhaps the byproduct of having a weakening Brussels and a sort of the central command kind of pulling apart, if you will, we may start to see more fiscal spending far in excess of, say, Maastricht Treaty levels, and that could be good news for local businesses. Maybe not exports to China, for example, in Germany, but in Italy, Spain, Greece, other places where we're going to get possibly more fiscal spending, and Brussels will let that happen.
Germany, the flash PMI, 47.6 today. That's the biggest drop in about 6 years. Are you unnerved by this yield curve again? Are we back to talking about that big time?
Well, I think so. I think it's always been part of the conversation, especially this late in the cycle. I've been calling for a flattening curve for about 2 years, really since after the election when the 2-10 spread was at about 135. And really the reason for that was very loose policy from other central banks globally, which anchors the long end of our curve. And now it's really coming more from an economic slowdown in Europe, in China, in the U.S., which just is not putting pressure on the long end yields. And so I think we'll be inverted by the end of 19.
By the end of the year.
I really do. And in terms of that silver lining in Europe, honestly, I don't see it. In terms of fiscal stimulus in Europe, it's very hard to accomplish. The Brussels is going to have to do a complete about-face from fiscal austerity to whatever they can do. Okay, so they get rid of a 3% deficit to GDP cap. That's not a heck of a lot of stimulus. That's the absence of austerity. That's very different.